Hey guys, and welcome to my channel Fiscal Voyage. My name is Felix, and in this video I have a company for you that has a dividend yield of 6.77% and projected annual earnings growth of 6%. I personally own shares of this company and I've done pretty well, and I'm expected to do even better as the time goes on because this company is very profitable and has been growing earnings and revenues and net income at a very substantial rate. So if you're new to the channel, make sure you hit that subscribe button because I like to cover dividend growth stocks and do stock analysis like this video here. So let's get started with the stock analysis. Okay, the stock analysis on British American Tobacco, ticker symbol BTI. I'm pretty sure you guys can figure out what the company does with the name tobacco in it. But it manufactures and sells cigarettes, tobacco, and other nicotine products. It's headquartered in London, England, and as of 2019, it is the largest cigarette maker in the world based on net sales. So we look at the fundamentals for British American Tobacco. Revenue grew at a nice rate of 6.3% annually from 2010 to 2019, and in that same 10-year period, net income grew at a better rate at 7.9%, and the company has a BBB plus credit rating, which is investment grade, and the likelihood of bankruptcy is very low. And operating income had an outstanding growth rate of 27% in that 10-year period, and earnings, however, lagged a little bit at 4.7% in this 10-year period. However, the past 5 years, earnings has been increased almost double to 8% for the past 5 years, and revenue grew at a whopping 18% in the past 5-year average, as well as net income at 7.4%. So the past 10 years has been doing really good, and the past 5 years has done even better. So there's progress of growth here, as you can see. Fundamentals continued. For 2019, the company had adjusted earnings of $4.17. Net margin came in at 22%. This is lower than 2018 net margin of 24%, so it compressed, and 2015 and 2016 had a higher net margin of 30%, so that's something of some concern there. So their profit margin is compressing here in recent years. Return on equity is 8.8%. It's been consistent at that rate for the past few years. Currently, the company has a very great yield, as I mentioned, 6.77%. That's real good. And the 5-year dividend growth rate is about 5%, because I say about 5% because the company, again, is a British company, so there's a lot of currency conversion. So some years it looked like the dividend was cut, but it wasn't. It's just because the dollar to pound or pound to dollar conversion changes the actual payout. But averaging out, it looks like the company has been growing dividend for the past 5 years at 5%. The dividend payout ratio based on 2020 expected earnings is 68%. And the company has been growing, what I've seen, about 20 years plus of dividend growth. But again, because of the currency conversion, it looks like if you were to research the company, it would look like it hasn't been growing dividends. But if you look at all the years of dividends, there's some years where it's slightly higher, and then the next year it'll probably be a little bit lower. And this is, of course, the conversion of the British pound to the US dollar. But that's nothing to be concerned of because they have been growing dividends, at least for the past 20 years, what I've researched. And the charter rule for the company come in at 11.77 points, which is right there at a minimum criteria of 11 to 12 or higher. So that's good there. And the 5-year dividend yield average is 4.74%. So the current yield is much higher than the 5-year average. So that's a plus there, almost 200 basis point higher. So that's real good news there. So it might be an indicator that it is substantially undervalued, but we'll see that later in this presentation. The balance sheet is fairly decent. The debt to cap at 47%, which is right there, is slightly high based on 40% criteria, but it's manageable. The current ratio, which is asset divided by current liability, so the company has more liability than assets. That's not good, but the debt to equity ratio is real low at a decent rate at 0.71, so that's positive there. The interest coverage, the company has 5 times
0.4 times interest coverage, so that's good there. So they'll be able to cover their interest at least. So that's good news there. And here's the exciting part. The price to book ratio of 1.14 compared to the 5-year average of 7.59. That's substantially lower current book ratio versus the 5-year average. So that's real good news here. So that's a good indicator that may be undervalued. And again, we'll see that shortly. So future outlook for British American Tobacco. 2020 earnings is expected to be $4.17. And again, this matches 2019 actual earnings of $4.17. So the company is expected to be flat for 2020, which again, with the economic shutdown and such, this is actually pretty good news. A lot of companies, as you guys I'm sure aware of, has been decreasing their earnings for 2020, and a few has increased actually, but for the most part, most company earnings has been decreasing substantially because of the economic shutdown. But British American Tobacco has expected earnings of flat, and they're expected to pick it up in 2021 to $4.46. So it's going to be much higher than 2019 and 2020 earnings. So that's positive there. And analysts expect a 3-year projected earnings growth of 6%. So that's good news there. So earnings are expected to continue to grow. So I'm happy about that. And the dividend yield return model came in at 9.4%. So this beats my criteria of 9% or higher. So that's good news there. And the forward PE of 8.8 versus a 5-year PE average of 13.8. So that's real good there, as you can see. And currently the company has a PE of 9.5, which is based on 2020 earnings. So the 8.8 forward PE is based on 2021 earnings of $4.46. So that's very good undervaluation just based on the PE ratio. So that's positive. So that's something I always look at, the PE, current PE, and the forward PE versus the 5-year PE average. And if we look at the fast graph, again, the black line is the monthly closing price, the orange is the earnings with a multiple of 15, and the blue is a normal PE multiple of 15.2. So we could say that the company is fairly valued at 15. And as you can see, the monthly closing price is much lower in 2019 as well as this year compared to their average multiple of 15. Currently, as you can see, the blended PE is at 9.47. If you were to buy shares at today's prices for 2022 expected earnings of $4.78, you can see you have a total annual rate of return of 32%. So that's very attractive. Investing $10,000 today has the potential of doubling your money in about 2 years. So that's real good there. That's very attractive. And as you can see, from 2013 to 2017, the company was slightly higher valuation, around 17 PE. So if it was to go back to the 15 PE multiple, you have a great return on investments at current prices. And the blended adjusted earnings yield, as you can see, is 10.56%. So that's very attractive. Beats that criteria of 6.5 and higher. So that's positive there. As you can see, the long-term debt to cap at only 47%, so that's manageable. But it's very attractive based on the fast graph. So I like this chart a lot. So let's look at the fair price for British American Tobacco. CFRA, however, doesn't have a fair price. They don't cover the company, so that's okay. So we'll use the other four. Morningstar gives a fair value price of $54. Fast Graph, as we just saw, with a PE multiple of 15, gives a fair price of $62.48. Yahoo came in at $52.34, and my dividend discount model analysis at $57.61. For my dividend discount model analysis, I use a 6% dividend growth for the next 3 years and 5% after that with a discount rate of 10%. That's how I retrieve this number of $57.61. Averaging out to 4, we get a fair price of $56.61. And as of today, July 3rd, 2020, the company goes for $39.47. And that gives us an undervaluation of 43.4%. That's outstanding. This beats my minimum criteria of 10% or higher. and 43% gives us a great margin of safety. Benjamin Granham, the writer of The Intelligent Investor, recommends a margin of safety of 30% or higher. We basically beat that at 43.4% safety of margin, so that's great. That's why I have a recommendation for BTI as a buy at current prices.
So as you just saw, I have a buy recommendation for British American Tobacco Company. The company has been great. I've personally owned shares. I'm not buying more shares right now because I'm very happy with the current position I own. But I'm up almost 15%, and I have a nice yield on cost of over 7%. So I'm very happy with my current position. But if I didn't own shares of this company, I would definitely be buying shares because it's very attractive price right now. As you just saw, the company has a BBB plus credit rating, the nice dividend yield of 6.77%, and projected earnings growth of 6%. So earnings growth is going to be increasing, therefore the dividends also is going to be increasing. One of the positive things that I see for the most part for this company is the 18% revenue growth over the past 5 years. So that's very attractive because as long as revenues continue to grow, they'll be able to increase their net income, increase maybe margin, and also therefore increasing the dividend. And also, as you notice, the price to book is very substantially low at 1.14 versus the 5-year average. And overall, for the next 2-3 years, you could possibly see an annual rate of return of over 30%. So that's very, very attractive. So I highly recommend you researching this company and maybe even consider it as part of your portfolio. Again, if this is the first time visiting my channel and watching this video, make sure to hit that subscribe button for more videos like this. And thank you for watching it, and I'll see you guys in the next one.